Once all the assets have been realized and the liquidator has paid the creditors, he has to consider the contributors to the company. If there is still cash available, the capital that was contributed by the shareholders will be returned to them. And then he has to consider whether there is any surplus available that can be shared between the contributors or whether there is a deficit. Now, companies in liquidation in most cases do not even have enough funds to pay their creditors, so let alone to refund their contributors. But in the rare situation where there's sufficient money to pay all the creditors in full, because they first of all have any amounts owed to them has to be settled in full, but the company is not in the position to pay all the contributories in full. The company is faced with a deficiency of funds for the shareholders. And then we have to calculate in what relationship are they going to share in that deficit. The overriding principle in any distribution of this deficit must be according to the company's constitution. So we'll always refer back to the company's constitution to see how a surplus, if that is applicable, or even if the more likely case of a deficit, how that will be treated amongst the different capital contributors. This is particularly the case if the company has preference shareholders or different classes of ordinary shareholders. The preference shareholders do not by default have a preferential claim to ordinary shareholders in the event of a liquidation, and any preferential claim must be stipulated in the Constitution. So the steps that we need to follow when we get to this stage of the liquidation process, the stage of returning the capital and any surplus or deficit to the shareholders, listed on the slide is then the steps that you'll follow in that specific stage. So first of all, we'll calculate the appropriate distribution of the surplus or deficit amongst the respective classes of contributors. If there are any unpaid calls, we'll make the necessary calls, or the liquidator will make the necessary calls on those unpaid shares. But when making that call on the contributory, so if there are any unpaid shares, there are two general principles that need to be followed by the liquidator. So no share is fully called up unless all the uncalled capital is required to meet the claim. So he's not going to make the call if that funds are not necessarily to settle the claims against the company as part of the liquidation process. And the call should be equal to the amount needed to meet the creditor's claim and to adjust the rights of the contributories. So we're going to look at an example now to see how he'll only make a call on certain of the classes of shareholders so that all the shareholders are in an equal position. The last few steps of this stage is then to close off the equity accounts in the general ledger, so transferring the share capital account balances, the reserve balances, then to transfer the balance on the liquidation account and to the shareholders' distribution account, and then finally to pay the shareholders if this is the case. So first of all, let's look at the first two steps, namely to calculate the distribution and to make any necessary calls on the hand of a simple example to illustrate this. Now, in this example, we're faced with a company that has been liquidated and they're now at the stage where they have to return capital to the shareholders. They've paid, realized their assets, and they've paid their creditors. And after the creditors were paid, they had an amount of $240,000 available in cash to distribute to their contributories. They have two classes or sets of ordinary shareholders, an A and a B class. And the B class they've got 550,000 issued, which was fully paid at $1 each, and then that's Class B, and Class A is 200,000 ordinary shareholders, also issued for $1 but only paid to 25 cents. In this situation, the first thing that we'll consider is what is stated in the Constitution. So if the company's constitution, for example, state that each of these contributories, so both the A and the B ordinary shareholders, will rank equally per share as to return of the capital. So in the case of a liquidation, they'll share equally in the cash that is available to the contributories. It means that all fully paid shareholders will receive the same payout per share, irrespective of what they actually paid for the share. So if we had, in this case, the two categories A and B, in this example, both of the shares were issued at $1 each, but for example, if they were issued at $5 and $7 respectively, it means that in a case of a liquidation, they would have shared equally, not taking into account what they've actually paid, the $5 and the $7 a share. So that's not taken into consideration. What, however, is taken into consideration is whether those shares are fully paid or not. And in this scenario, we sit with an A category shareholder that has only paid 25 cents, so 25% of the share issue price. So it is common practice to include a stipulation in the company's constitution that shareholders are liable up to the amounts unpaid on their shares. So during a liquidation, shareholders will still be liable to the company for the amount that has not been paid on their shares. And this stipulation is included to ensure that shareholders who are actually fully paid is not at a disadvantage compared to those who hold only partly paid shares. Okay, so back to our example. From the liquidation process, we see that we've got cash available of $240,000. Now, theoretically, we have more cash available for distribution if we take into consideration the liability of the A ordinary shareholders. So if we add to the cash that actually is available, the unpaid call that is available, that is 75 cents per share times the 200,000 shares equals 150. We've got a total amount of cash that is theoretically available of 390,000, because after we've made this call, the both the A and B shareholders will be in a similar position, namely that their shares are fully paid. We call this $150,000 the notional call, because that is theoretically what we can also get from our capital contributors.